This here is the data that the elites don't want you to know. It benefits the few at the expense of most, but we can take advantage of this as well if we just know how the system works. What we see here is the comparison of three growth rates. USM2, so the US money supply, that grew by 6.7% over the last 60 years, roughly. In red, we see the median house price. In blue, we see the median family income. The money devalues at the quickest rate. House prices are able to at least partially offset that devaluation. Incomes tend to grow the least quickly. Now what's important here is we are looking at the median house versus the median income. We're not even looking at the average house or the average income. For the median family, it gets harder and harder to afford a house. And that's maybe one of the reasons why birth rates are declining, right? It's harder and harder to get ahead in life. And we are just looking here at family income, at household income. We are not even looking at individuals' income because those obviously went down even more because now we've got more labor participation. Why do house prices not fully offset the monetary devaluation? It's because a house that's 30 years old or 50 years old is obviously not as desirable as a new house. Still, property tends to go up, measured in US dollars over time, because the money devalues quickly. The reason why all of this is happening, and yes, this might be a conspiracy theory, but I believe in it, the reason why this is happening is to keep most people poor at the expense of the few. There's clearly a capital concentration happening. There's more and more of a shift of the average versus the median. So the median is just what splits the bottom half from the top half. The average is when we look at all of the values and then we just divide it by the number of values. So when we've got strong concentration towards the richest, that pushes up the average relative to the median. And the sinister thing about all of this is not only that it's accelerating, but also that this happens both to wealth, but also incomes. Have a look at the net worth ratio. So that's the line in orange. This looks at the median net worth relative to the average net worth. So how much is the typical Joe that's in the middle falling behind the average that's getting pushed up by the few people that are able to accumulate more and more net worth in this case through investing and through other means. The thing that most people don't have on their radar is the income ratio. That's also going down. So it's not just harder and harder to accumulate wealth over time, it's also harder and harder to generate income over time. The income is concentrating. Now, all of those long-term trends have, of course, an impact on how investments are made. Right? A few decades ago, it was quite common to have a 60-40 portfolio. So to have 60% of one's assets in stocks and 40% of one's assets in bonds. So you've got a part that's risk on, another part that's risk off. Nowadays, the younger generation doesn't want to own any bonds at all. They're considering, should I have an altcoin portfolio and be risk off with the Nasdaq 100 tech stocks? Please again, think about this. Those are logarithmic charts. The money supply grew by 44x, while the median income grew only by 12x. Of all of the purchasing power in the US, measured as the M2 money supply, income of all of the purchasing power in the US, measured in the US dollar, USM2, the median income now has 73% less of a share. So we look at the 11.7 relative to the 43.6, there's only 27% or a drop of 73% in terms of relative purchasing power. Where is all of that purchasing power going to? In other words, why do we have a system where most people seem to be falling behind every single decade? Why do we accept that birth rates are declining, that people are struggling more and more? We accept it because a few people have figured out how to play the system. And I want to talk about how we can take advantage of this in this video as well. This might be the most important video you watch the entire year. Have a look at this chart over here. This now compares incomes. we are not looking at net worths and investments at all. We are just looking at income. USM2, the monetary devaluation, is 6.8% per year. If you are in the top 10% of households, you're still underperforming that devaluation by 1 percentage point per year. So you grew your income by 5.7% per year. So if you're in the top 10% of earners, the median house is still affordable for you. The median house went up by only 5.1%. You're on the top 10 and you can't afford a median house. But who's really benefiting from this is the top 1%. At least that's the story. But have a look at the top 1%. They grew their income by 6.0%. That's still less than USM2. You can be among the top 1% of earners, which is more than $500,000 per year. And you still don't grow your income as quickly as the monetary debasement. What on earth is going on? This is not the 1% versus the 99%. This is the 0.1% versus the 99.9%. The beneficiary of that system is not the income earners. You can be very strong in earning income and still fall behind decade over decade. If your income is currently $500,000 per year, then you are clearly a top earner. Yet, if you stay at that level for another decade, if you adjust for inflation, you will still fall behind. You can be at $500,000 this year and you can grow this income by 6% over the next year and still money devalued by 6.8% per year. You don't really feel it that much, but you're really not getting ahead, relatively speaking, right? You will not have a better life 1 year from now compared to this year if you don't save. And this is exactly the point of this video. The winners in the system are not necessarily the savers. The winners of the system are the people that have debt that devalues over time. Debt that is cheaper than 6.8% per annum. The cheaper you can finance something that keeps its value, the more you can play the system. If you own something that goes up at a quicker rate then those 6.8% per annum, you will make money. And that has to be earned not with active income, but with just playing those interest arbitrages. Why is USM2 growing in the first place? It's because credit expands. Money in a fiat system is created through loans. If you're among the people that owns a lot of debt and that can service that debt and that sees that debt devalue over time, you become a winner. That's the only realistic way. Income generation will not be enough. Now, what kind of consequence does this have in the investment universe? Have a look at long-term government bonds, for example. That's at the top, TLT, a long-term government bond ETF. At the bottom, we've got the Fed funds rate. The idea is that when the rate is going up, that bond prices should go down. When the rates are going down, that bond prices go up. But we can already see how that connection is not very strong at all. We saw monetary tightening from here to here, yet bond prices didn't really crash. We saw monetary easing from here until today, yet we don't see bond prices going up. The 60-40 portfolio is dead. Nobody wants to hold government bonds anymore. Here is the gold price relative to the monetary base. This year was the Nixon shock, where the US dollar was not anymore pegged to a fixed amount of gold. Massive inflation followed, and then came Volcker. Volcker increased interest rates, which was a counterweight to all of those inflows in gold. It doesn't pay anything. Then the gold price collapsed. Recently, we see a resurgence of gold, but that's also coming down. I expect this to further fall. So it's not bonds anymore. It's not gold anymore. Partially, people have moved on to stocks, right? The S&P 500. But even that can barely outperform the monetary debasement over the years. This year, 66 years of data, and the S&P 500 has outperformed the debasement by 81%. Now, there's a few caveats here. The S&P 500 is a price index, not a performance index, so we do get dividends on top of that. But we also get taxes on top of that. We also get fees on top of that. So really, are the dividends that big of a deal for the average investor? I'm not so sure. The S&P 500 is able to somewhat escape the system that robs everybody from purchasing power. Again, right, this is the median household income, not even able to buy the median house anymore. And houses aren't even able to keep up with the debasement because houses age. Effectively, people are getting squeezed more and more, and they are forced to take on more risk just in order to keep up. Costolani said this already 30 years ago. Those who have a lot of money can speculate. Those who have no money must speculate. If you just want to have an average lifestyle, following the average playbook doesn't work anymore. And getting into riskier investments seems to be the legitimate way. At least it's not gambling in a casino. But I think that's one of the major reasons why technology stocks long-term outperform traditional stocks. People simply need more return. Their incomes are falling behind, and so their capital has to work extra hard. This year was the dot-com crisis, but outside of that dot-com crisis, we still see continuous outperformance. The more desperate an economy is, the more the wealth is concentrated, the more of that kind of speculation we see. Right? I don't think it's a coincidence that the birth rate in Korea is super low, but at the same time, the amount of retail speculation in the economy is extremely high. People simply just want to get ahead. And I also think that's one of the main drivers why Bitcoin saw that much adoption. This is Bitcoin relative to technology stocks. People are getting hungrier and hungrier for outsized performance over time. And so they're willing to potentially be exposed to drawdowns of more than 80%, as long as the long-term performance is promising. And that's one of the major fundamental reasons why I think Bitcoin will experience a comeback. It will again outperform versus technology stocks after it has crashed more than 50%. People are not getting back into government bonds. It's simply not a valid option. People are simply looking for the next thing. And while this might not necessarily be Bitcoin, it has to be something that's highly risk on. It has to be something that promises multiple X returns. If you lost versus the debasement of the dollar by a multiple X, you need a multiple X on your few dollars that you've been able to save to catch up again. And so the best way to game the system is to have a lot of cheap debt and buy things that have a lot of upside potential as well. Now this can only work when it's very easy to serve the debt, so the monthly payments aren't high, if that debt can't be recalled, and also if the risk that we take on is highly diversified, so that we don't put everything into one single altcoin, for example. But we can definitely work with cheap leverage, right? We could go 2 or 3x on several high risk things as long as they are not correlated. We could have a 2x Bitcoin ETF, a 3x gold ETF, and we can also go 5x levered on a house, for example, right? We only pay down 20%, we finance the remaining 80%. It's credit creation that takes away purchasing power from 99% of people. You can work very hard on increasing your active income. Even if you are in the top 1%, and you're making more than $500,000 per year, you will fall behind if you don't follow an optimized investment strategy that takes advantage of this system. Now down below in the pinned comment, there is a cheat sheet. How we can spot the big picture behind every move. How money is flowing from asset class to asset class. How interest rates impact different asset classes, etc. It's 100% free. You can either get it via Telegram. You can scan this QR code over here. Alternatively, click the button. You can also get it via email. Just plug in your email over here. No payment is required. No credit card is required. It's in the pinned comment down below. If it's the first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. Helps the channel grow. See you next time. Cheers.